The Federal Reserve operates as the ultimate source of macroeconomic policy and the foundational liquidity that keeps the global system upright. Yet there is a distinct gap between these high-level policies and daily market operations on Wall Street. Standard financial education reinforces this gap, teaching macroeconomics and equity valuation in isolated silos that rarely intersect. For fundamental equity valuation, the Gordon growth model remains the bedrock equation. If we accept that commercial banks can theoretically create infinite credit from thin air, we face a paradox. Why does the system ever experience a breakdown? In practice, we see that central bank rate hikes and quantitative tightening consistently trigger immediate liquidity crises and cascading failures. To accurately value assets, we have to look past isolated theories and trace the mechanical transmission of liquidity from the central bank to the stock price. This process begins with a single liability on the Federal Reserve's balance sheet. We can track exactly how a sterile central bank accounting entry moves into commercial bank clearing accounts, expanding the money supply. This sequence dictates the variables in the DCF model, shifting valuations even when corporate fundamentals remain static. Mastering this pipeline allows an investor to mathematically model liquidity flows rather than guessing at market direction. We have to move past the common misconception that banks are mere intermediaries that take in deposits to lend out a fraction. This textbook model, where customer cash simply moves from a vault to a borrower, is flawed. We start with the foundational tool of monetary plumbing, the commercial bank T-account. When originating a loan, the bank expands its balance sheet via electronic keystrokes, simultaneously creating a loan asset and a deposit liability. The broad money supply expands at that exact moment. This credit expansion is not limited by the amount of customer deposits the bank currently holds. Instead, the actual ceiling for credit creation is determined by regulatory capital requirements, such as the capital adequacy ratios defined by Basel III. Commercial banks act as primary money creators through accounting, operating independently of their retail deposit base. If a bank can conjure money through a ledger entry, why would it ever pay interest to attract consumer deposits? Consider sending that newly created $100 million to a vendor at a different bank. As the deposit moves, friction emerges. Wells Fargo requires settlement using central bank reserves. JP Morgan must drain its own reserves held at the Fed to complete the transfer. If a bank creates loans too aggressively without maintaining enough reserves, it will trigger a technical default in the interbank clearing system. Retail deposits are vital. They provide the reserves needed to backstop these daily clearing operations. While banks create credit through accounting, they remain settlement slaves to the central bank's reserve system. The dynamics of this reserve system shifted significantly following the 2008 financial crisis. Through quantitative easing, the Fed flooded banks with trillions in excess reserves, establishing what is known as the ample reserves framework. This flood of liquidity made the reserve requirement ratio obsolete, eventually leading the Fed to drop it to 0%. Without a quantity-based requirement, the Fed now manages lending by adjusting the price of money through the interest on reserve balances, or IORB. By offering a high, risk-free IORB rate, the Fed incentivizes banks to hold reserves in the clearing system rather than lending them into the economy. When the Fed seeks to remove base liquidity entirely, it utilizes quantitative tightening. Quantitative tightening destroys reserves directly from the system. This rapidly pushes commercial banks closer to the dangerous interbank clearing failure line. Today, central banks regulate economic speed through the IORB price ceiling and liquidity drainage via QT. We can connect these macro mechanics back to the investor by returning to the core equity valuation formula. We can draw a direct line between M2 money supply expansion and the growth variable G. Expanding reserves spur M2 growth, which serves as a proxy for nominal GDP and inflates corporate revenue expectations. A second pipeline connects IORB and rate hikes to the cost of equity, K. These hikes increase the risk-free rate, raising the required return and putting downward pressure on valuations. This creates the Davis double play, often seen during periods of easing. During QE, the cost of equity K falls while the growth expectations for G rise. This compresses the denominator, which mathematically forces the asset price, P, higher. This denominator compression acts exactly like a tightly coiled industrial spring, rapidly driving asset prices upward with a massive amount of kinetic force. Systemic rallies and crashes frequently occur because liquidity mechanics have overwhelmed the corporate cash flows investors are trained to watch. While commercial banks conjure credit, they remain tethered to the settlement reality enforced by the central bank. The Board of Governors regulates the foundational reserves that enable the entire M2 multiplier. Understanding these hidden conduits allows an investor to see the constraints that govern asset prices before the rest of the market reacts.